The Federal Reserve released its first statement of 2015 just moments ago. Interest rates remain unchanged, and the Fed maintained its vague stance on when investors should expect a rate hike, saying they can be patient when it comes to normalizing policy. For reaction, I'm joined in studio by Jerry Webman, chief economist at OppenheimerFunds. And Jerry, economists weren't exactly expecting anything new out of the FOMC this time around, but give us your reaction to this statement.
Well, continuity is an important message in and of itself. So they've said we're on track. What we've more or less expected the economy to do, it's doing. Inflation, we should talk about that, is a little bit of an issue that they're grappling with. But basically, the U.S. economy is on track. They strengthened some of the language about how confident they are that the labor market in particular, but the overall U.S. economy is on track. So they only want to shock us if they need to shock us. And today they just needed to bore us, and that's what they did.
Now, there is talk that a rate hike could come now in September instead of June, largely because of the ECB's massive stimulus. What's your take on timing on when the Fed will actually pull the trigger?
Well, the ECB's action this is like Harry Truman, right? I want a one-handed economist because it's one hand on the other hand. So it's a one hand on the other hand story. In a way, the ECB being easier allows the Fed to act sooner because there's stimulus in other parts of the world. On the other hand, it might keep them from acting as soon because it strengthens the dollar, weakens the euro, and that has a dampening effect on the U.S. economy. So net-net, I'm not sure the ECB action really changes the calculus of the Fed in deciding when it's appropriate for the U.S. economy to begin changing policy.
So you think we still could be at a June timeline?
I think June is likely. You know, we've got a lot of meetings. There's June, there's July, and there's September. June is what they've telegraphed to us. We'll have to watch what we call open mouth operations to see if they try to steer us away from something that June, July. I don't think for investors. I don't think it really matters very much, perfectly frankly.
All right, let's talk about inflation. The Fed in its statement today said that it expects inflation to move back towards its 2% target in the medium term, but yet oil prices are down 20% since the Fed's December meeting. So are they missing something? Well,
they obviously know about this, so I'm sure they're not missing anything. It reminds me of how angry people got at the Fed when oil prices were over $100 a barrel and they said this is transitory, and we all got mad at them, or at least some people got mad at them. I think they were right then, and I think they're right now. You know, the cure for high prices was high prices. The cure for low prices is low prices. You can't manage monetary policy based on commodity prices, even something as important as energy. So they're going to be watching for wage inflation, which has been pretty limp, and consumer confidence. And they're going to watch hiring, which has been very good, actually. And they're going to watch, you know, risk-taking by businesses in industrial production and so forth. So that's what they're going to be watching. Things like oil prices matter to you and me, but they are, the Fed appropriately says, transitory phenomena.
All right, Jerry, we'll leave it there. Jerry Webman, chief economist at OppenheimerFunds. Thanks for coming in. It's great to see you.
My pleasure.
I'm Scott Gamm, and you're watching The Street.